Hi, and a big welcome back to the channel today. Thanks so much for tuning in. I'm Neil McCoy-Ward, and today we're going to be looking at the stock market again. I'm going to be doing a follow-up video to my video last month where I said the stock market was going to collapse, and it is going to collapse. It's only a matter of time. And since there were a number of people that didn't agree with the forecast from last time, I thought I would add even more indicators and even more data and evidence to today's video so that there can really be no question in anyone's mind that the stock market is going to implode upon itself. And I don't need to tell you that the stock market is absolutely booming right now. It's at an all-time record high. And a lot of financial commentators are saying, "Oh, I can't understand it. I just can't understand why it's going so high." Really, I don't know why people can't figure out why it's going so high. It's pretty simple when you understand the basic fundamentals of economics and finance. So I'll be going through some of those fundamentals today so that it doesn't matter if you are a financial literate person or you really don't know very much about finance at all. You'll be able to understand these indicators. I'm going to put it in very common sense, simple language for anyone to understand. So with that said, let's go to the shared screen now then, and let's get into it. So we're going to start then with the Dow Jones 100-year index. I won't use the S&P just yet. I might use it a bit later. I also won't use the Wiltshire at this stage. I'm just going to use the simple Dow Jones. We're going to show recessions. We're going to adjust it to log scale and inflation adjusted, just so that no one can come back on me and say, "Oh, your data wasn't accurate." All right, so we've got all of this on here. Now, let's take a look at this then. And we can see with all of this adjusted, that right now the stock market where it's sat is at an all-time high, despite being in one of the worst recessions that we have ever seen. And again, this is a man-made recession. Have no illusions about that. This is not due to the virus. This is due to the fallout that governments have, their responses have made to the virus by all the lockdowns and things like that. And really, it is the Federal Reserve that are behind this boom in the stock market. Have no illusions about this. The Federal Reserve are trying not to do what they did in the 1930s. If you know what happened with the 1929 Great Depression, this was actually two deep recessions which caused a depression as a direct result, and the Federal Reserve openly admit this, that they made a big mistake by raising interest rates. This created a liquidity trap at the time, just sucked all of the money out of the markets. There was no money going around. And of course, it created this huge recession, depression, drop in the markets. There was just no money available. So this time around, they're doing the opposite. They're dropping rates to an all-time low, about as close to zero, or we're even discussing negative rates right now. And of course, this isn't the perfect solution either, because what's now happening is we've got too much money in the monetary supply. And of course, where's all of this money gone to? Where have the stimulus checks gone to? Where has, with bonds being so low, where's all the money gone? It's going into the stock market. It's going into the real estate market. So now what the Federal Reserve are doing is they're creating an asset bubble as a result of these low rates. So we're going to look at three indicators now then. The first one is the price per earnings ratio, also known as the PE ratio of the stock market. Fantastic indicator, which tells you basically if the stock market is undervalued or overvalued. The second one is the Buffett indicator, named after Warren Buffett, but this is basically market cap versus GDP. And then the third one is corporate debt to GDP, another fantastic indicator. So let's go through these now then. So what is the PE ratio then, the price per earnings ratio? Well, this is the share value relative to its earnings. Okay, so that's the most simple way to look at it. A healthy PE ratio is about 15 to 16. Historically, that's always what it's been. It's about 15 to 16. Now let me show you where we are. And we're going to use Shiller. So this is Professor Shiller out of Yale University, who is an absolute genius. If you don't know who he is, definitely worth looking him up. He's one of my go-to economists that I always look to. And here we are. Here's the PE ratio then. And you can see where we are right now. If 15 to 16 is a good ratio, which is down here sort of level, we're up here at almost 32 as of right now. And let's look back. Black Monday, where were we here? Way below where we are right now. This is the dot-com crisis, if you remember the dot-com crisis. You know, this is insanity. 2008, the housing crisis. You know, look at the drop that happened here. And if we go back to the 1920s, 30s, we had the big run up for a decade up until Black Tuesday, which was a 30 price per earnings ratio, before it crashed right down here, which is what, 6 or 7, before climbing up a little bit. But you can see where we're going here. And let's look at another ratio. We've got another chart here. This is again going off the Shiller price per earnings ratio. Historic average 17.1. And look here, this was the dot-com crisis at 44.2. Again, let's look over here and get the accurate number on this. This was 32.6. Now look at what we are right now. We're at 30.3 according to this chart. Hi, if you're enjoying this video so far, could you do me a quick favor? Just click that like button below. It doesn't really bother me, but it bothers YouTube. If you click the like button, it boosts the video in the algorithm and allows more people to watch it. And also, if you're not subscribed, why not subscribe to the channel? I bring you videos like this every single week. If you don't think that we're in a bubble right now, where we are at 30.3, I really don't know what else to say. This indicator is fantastic. It's been very accurate over time. And this is one thing that I definitely go by. So what this means is that we are massively, massively overvalued in the stock market right now. I mean, hugely, hugely overvalued. 17 is the average. Below 17 for me is a buying indicator to get into the stock market. When we get much over 20, for me, that's a selling indicator to get out of the market. So at 30, I mean, I'm going to put my cards on the table here, ladies and gentlemen. I'm completely out of the stock market, right? And I'm an investor. So you've got to think, why would Neil completely get out of the stock market if it's his job, right, to invest? And again, I'm not selling you on anything. I'm not trying to sell you, you can't join my fund or anything like that. This video today is really just to help you because I do care. I don't want all of you to get completely wiped out, especially if you're a subscriber of mine and you've been following, the videos I've been making. I know a lot of you have made a lot of money from following my videos over the last year. So let's get on to the next indicator now then. And this is the Buffett indicator, which is what I mentioned. Basically market cap to GDP. So let's look at where we are right now then. And again, look at this. This is an all-time high. Q2 of 2020, the Buffett indicator shows a 2.2. This is just insanity to see these sort of numbers. And let's look at the last time when we had a high number. So that was 2000. So this again, just before the housing crash, it was at 1.5. And look where we are right now, 2.2. And it crashed when it was at 1.5. And it dropped down to 0.8, which again was another buying indicator. This is when you buy. Again, a lot of people make the mistakes with the stock market in that they see everything booming and all these shares going up massively and rapidly, and they think, I've got to get in right now. Well, no, that's what happened in 1929 or leading up to the 1920s. Everyone was involved in the stock market. You've seen the videos, the butcher, the baker, everyone was involved in the stock market. And worse yet, they were taking loans out to invest in the stock market. And you know that what happened after that, we had the greatest depression we've ever seen. So just use all of these indicators, use history to teach you a lesson here. Let's see what else we've got. We've got the 2000, the dot-com crisis. Again, look where we were, 1.86. And we crashed right down to, again, the red line, getting back to the 1. Look where we are right now. I don't know how many times I can say this, and I have to keep drilling it in because I keep seeing so many people jumping into the stock market right now at the worst possible time you can be getting into the stock market. This is from advisor perspectives. These are also very good. I highly recommend you check these guys out, look at their website. This is their Buffett indicator again, and they're using it as a percentage wise, right? So you can see where they've got it placed at 171%. Again, dot-com crisis was 159% by their charts. And then we have here the 2008 crisis. We were at, what's that, 117, 118%. So this video isn't designed to teach you all of these indicators in detail. I'm just really showing you an overview so that you can do your own research on this. Let's look at the next one then. This is from Guru Focus. I really like Guru Focus. So this is gurufocus.com. And this is the chart that really does it for me. So if this is the ratio, so this is your total market cap over GDP, and then they've got a valuation here. So significantly undervalued would be under 73%. A fair value, 93% to 114%. That's a fair value. Okay, significantly overvalued, 135% or more. We are right now at 184%. So this just blows this completely out of the water. Okay, before we go on to corporate debt over GDP, let's just look at the general GDP of the United States and let's see where we're at. Okay, very slow growth throughout all these quarters going back to 2017, pretty standard. And then of course we had the minus 5% here, which was back in early of the year due to the financial crisis or the pandemic, whatever you want to call it. And then we had this huge drop off at 31.4% of GDP, a new record. And it doesn't matter which chart you look at. This is from bea.gov. Everyone is showing the same sort of figures in terms of the loss of GDP. And what I don't understand is why all of these economists and why the mainstream media isn't explaining what this means. Okay, you've just got to look at this very simply. When you have a huge drop in GDP, this causes a massive crisis to occur. It kicks the can down the road. We haven't seen this big crisis yet come to full fruition. This is going to happen, right? When you have this big loss in GDP, you have all these furlough or let's say job losses. Job losses means that you're pulling money that people would have spent, these are consumers in the economy. 70% of the economy, or let's say 70% of the GDP is made up of consumer spending, right? Again, this isn't taught. I don't know why they don't teach this stuff. So when you're pulling out all this consumer spending and you have these high unemployment rates, and the rates we're talking about that are shown on the media are complete falsehoods, they're not accurate. We're more like 25% if you look at it accurately and you take into account people who are not looking for work and all the other variables here. I won't go into it because it's on other videos. We're more like 25% unemployment rate. We're not anywhere near what is being told to us. So this is going to have a huge effect. We have all these forbearance programs going on. People can't pay their mortgages right now. You only have to look at the food banks and seeing the lines going around the block. You only have to see all these, the charities that are requesting money to help people. You go out on the street, you'll see people, the homelessness is just rising, shops shuttered. This is all going to come to a big problem later on. We haven't seen the crisis yet. And the next thing that I want to show you here is the S&P 500 to GDP ratio, just so that, again, no one can say, well, you were just showing the Dow Jones. So let me show you the S&P as well. This was the dot-com crisis, the dot-com bubble here. You can see the ratio. This is where we went into the 2008 crisis, the housing bubble. You can see where it dropped to. And this is where we are right now. I think the graph says it all for me. I don't really need to comment anymore on this. Okay, let's get into the Fred data then. So this is data not from me or anyone independent. This is from the Federal Reserve of the United States, this data, okay? And this shows the Wiltshire 5000 full cap price index. And you can see where we are right now. Again, you can see we've had this massive run up where we are sat right now. I'm now going to show it you from a different point of view. This is the Wiltshire 5000 total market cap against GDP, all right? Now look at this, look how similar it is. Can you see the correlation here? There's only a slight difference, which is this section here. But you can see how closely this is being tracked. Now, what happened here? We had a decline. What happened here? We had a decline. Look where we are right now. It's pretty obvious to me what's going to happen, but I'll leave it up to you to decide. And then let's look at non-financial. And you know why it's non-financial. If they show you the financial corporate business debt, this will just be off the charts. So this is the non-financial corporate business debt, securities and loans liabilities level. And look where this is. Q2 of 2020, look at this. I mean, this is just unheard of. This is climbing at such a rapid rate. Corporate debt is just exploding. And I'm really worried about what's actually going to happen. And I personally think that the corporate sector is going to have a huge problem very shortly. When all of this comes crashing down, they are going to suffer badly because they're not going to be able to pay back this debt. All of this debt, all of this over leverage, there's no way they're going to be able to pay all of this back. So I'm very concerned for what's going to happen to the corporate sector going forward. They made just huge mistakes, huge mistakes. They should have invested all of this money they were getting at really low interest rates into R&D, research and development, into efficiencies in their company, into growth for the future, into their people, the most important resource of any company, the people. They didn't do any of that. Instead, corporate greed got in the way. They paid their top 0.1%, huge bonuses. They paid their CEOs hundreds of millions of dollars as a salary, plus the stock price. And when you have incentives like this, it creates greed. So rather than doing the right thing, these corporate executives instead focus on increasing the share price, because what happens when they increase the share price? They increase their wealth in accordance with it. So we're in a broken system, ladies and gentlemen, we really are, and this is only going to get worse. And this is another chart I want to show you. This is from longtermtrends.net. Again, I highly recommend this website. And we can see what's happened in previous crashes. Here's the 1980s leading up to the 1990 crash. This was the dot-com bubble. Again, look at the corporate debt to GDP here. Came crashing down. Then again, we had this big run up to the 2009. And we had the housing bubble. And now look at this run up. Look at this. Look where we're sat right now. 56.33%. This is higher than it's ever been. If this isn't a huge bubble in the stock market right now, and let's put these aside and let's look at one other thing. These businesses are losing money at a rapid rate. They're not making huge profits. They're losing money at a rapid rate. The stock market itself, a lot of the companies are actually shrinking. They're not profitable. They're losing money. A lot of people are saying the stock market's booming. It's booming. No. The big companies in the stock market are booming. Apple, Amazon, the big players, Tesla. This is where the money is going to. It's a mistake. These companies are overvalued, right? They are overvalued. When it takes 50 years, right, to get your money back on the price of a share, it tells you it's overvalued. The share price of a company is a direct reflection of the value of the company, of its profitability, of the money that it's expected to make in the future. What we've got now is just smoke and mirrors. It's all been inflated by all of the new money creation from the Federal Reserve, trying to prop up the market. And when you have these historically low interest rates, all you're doing is you're stealing from the people by them losing money from their savings, because inflation, right? If you get higher inflation than the savings rate, you're stealing from the people. The banks are using this money, and they're not even doing fractional reserve banking anymore, where they're loaning it at a X percent or X times on the money. They're just loaning out money. They're creating bad debts. They're just loaning to anyone in some regards. This is all going to end really, really badly. The Federal Reserve have lost touch. They may have started out well and they may be trying to do their best, but this is going to crash everything. They're going to crash the economy with these measures. So, guys, that is it for the charts here. I think really you need to make your own decision on what's going to happen here, but I think it's pretty clear from what I think and what I've said what's going to happen. Well, thank you so much for watching this video today. Please just click the like button if you haven't already. Consider subscribing to the channel. And I hope this really helped you to understand the stock market a lot better, understand where it's come from, and ultimately where it is going to go. And again, you know, your financial advisor isn't going to tell you a lot of these things. Your stockbroker isn't going to tell you a lot of these things because their livelihood depends upon the stock market continuing to go up. Their commissions depend upon the stock market continuing to go up. So it's very unlikely that they will tell you to exit the stock market. And again, I'm not telling you to exit the stock market. What I'm saying is this is your choice at the end of the day. It's completely your decision. You should sit down and really go over this very carefully and make a decision both from the fundamentals, the mathematics, or the indicators, and from an emotional point of view as well. Now, I don't mean an emotional point of view of being in a fear mode, but an emotional point of view of deciding what is more likely to happen and what's more important to you. Would you rather risk all your capital and therefore lose a lot of it when this crash finally happens, or would you rather pull your money out now, put it into, you know, a savings account or multiple savings account, diversify it, and, you know, just accept that the market could even continue going up and you would have lost those gains, but at the same time you won't have lost everything if there is a complete collapse. So I hope that helps. Take care as always, God bless, and I'll see you next week.